Chapter 6, we talk about journalizing payroll, so how we create the journal entries. So basically, payroll is going to require entering all of the data. So the company is going to prepare the payroll register, which would list out every employee, what their gross pay, all their deductions, and what their net pay was. There'll be employee earnings records. So for each employee, they would look and say, okay, these are my current earnings, these are my year-to-date earnings, these are my current deductions and my year-to-date deductions. But then it creates the journal entries. So in the general journal, there's going to be a journal entry that will show the gross payroll and all the withholdings. Then there's going to be a separate employer entry that's going to charge the employer's portion of those payroll taxes and workers' comp and unemployment taxes to expense, and then set up those liabilities. Then we're going to make payments. We're going to pay those liabilities when the time comes, and we're going to pay the payroll itself. And then at the end of the year or the end of the month or the end of the quarter, there may be times that they accrue those wages. So you're at the end of the year and you've got 3 days of December that's going to get paid in January. Well, we're going to want to set up an accrual for those. Okay, so then when we first get again into the payroll register, all the employees are listed, and within each employee or each employee line, there's going to be their regular earnings, their overtime earnings, their total earnings, all of their taxes that were withheld, and all of their deductions. And we're going to talk about all the different types of deductions that there can be in payroll, because there's a lot, and then that will total up to their net pay. The employee's earnings, again, is specifically for each individual employee, and it's going to show their current earnings, their year-to-date earnings, all their withholdings, and then that is used how they create the W-2s for each employee. So again, when we actually record it, we're going to record the gross payroll as a debit to wages expense or to salaries expense. And again, maybe it depends on how large your company is. Maybe it is broken out by department. If it's not just one lump sum for wage, then maybe it goes to, like, they're showing research or technology or the accounting or productions or kind of whatever the different departments might be. Then all of the withholding taxes, so like your federal unemployment tax, your state unemployment tax, your Social Security and Medicare, all of those withholdings are credited to separate liabilities. And then if you, again, like I said, there's all kinds of different payroll deductions. So say you have health insurance, those are going to get credited to a liability. If you've got life insurance or other, again, there's a whole list. So here is the very common one, probably the most common, is that people will have insurance, whether it's health insurance or life insurance or both. So then those individuals will have that withheld. Their portion will be withheld out of their paychecks. So a lot of times, though, the employer is going to pay probably a higher portion, but that is separate. If we're just looking at our payroll register, what they're going to have is the withholdings coming out of the employee's paycheck, and those are going to get credited to a health insurance or a life insurance liability. And that liability then will get reduced as those premiums are paid to the insurance company, and then those premiums may be paid at a different sequence. Like maybe they pay semi-annually or quarterly or something like that for insurances. Again, health insurance, so I was kind of talking about both of those, but it's basically going to be the same thing, where the amount that's being withheld from the employee's wages is credited to that liability account, and then the employer's portion is normally going to be paid separately. And sometimes employers, like when I worked at the oil and gas company, we were self-insured up to a certain dollar amount. And I forget the dollar amount, but let's say it was like the first $25,000 of healthcare costs for each employee, the employer actually paid. It was all set up through a health insurance company, though. But then they just billed the company for all those expenses as they were incurred. Then if you got over, so if you were very seriously ill and it was over the $25,000, then the whole insurance plan would kick in. But as an employee, I mean, I only knew that because I worked in the accounting side. As an employee, you didn't know. You just knew, okay, I'm going to have $75 each pay come out for my family plan or whatever it is. And then again, this talks about that because it is health insurance is an IRS approved cafeteria plan, those premiums that, like I'm saying, the $75 that came out of my paycheck for a family coverage was not included in my taxable income. So it was pre-tax, which was nice. Okay, then garnishments. So garnishments can happen to employees. It's when they owe money to a variety of different things. So like they show us in here, there's different priorities. But the employer has to comply with that garnishment order. It's a legal order to take money out of their paychecks and submit it to the appropriate agency. So it could be due to bankruptcy, and then if you can remember your business law, Chapter 7 bankruptcy is where you just get liquidation of your debt. So any non-exempt assets are sold off, the proceeds go to pay the debt, and then all your debt is discharged. So in that case, there would be no garnishment. Chapter 13 is the one that does garnish your wages. So if you are over the median income of the county and you go into bankruptcy, they're going to push you into Chapter 13. So over 3 to 5 years, you will have your wages garnished, and those wages will go to the court-appointed agent who then pays off the debt that is included in that bankruptcy. So we can see that's a top priority. Obviously, federal income tax, if you didn't pay your taxes and you owed the IRS, they can garnish your wages. And child support, also your wages are garnished. Then below that is any creditor debt or student loan debt that could come through in a garnishment. So say you have a medical bill that you didn't pay and they've tracked you down, it went to court, they've gotten the authorization to garnish your wages, it goes to your employer and they're going to start withholding it. So this Consumer Credit Protection Act limits the amount of wages that are subject to garnishment, again, depending on the type of garnishment. And the textbook gives you a nice little table of that, so you may want to look back in there. But the maximum amount that can be garnished is 25% of the disposable income, the disposable earnings, or the amount by which those disposable earnings exceeds 30 times the federal minimum wage rate. So they're trying to protect the lower income people to be able to still have a check, to pay their bills and things like that. So again, these priority garnishments, the child support payments are very common. If there's a divorce and one of the parents, is paying for the upkeep of the child to the other parent, then that Family Support Act requires immediate withholding of those child support payments. The employer can withhold for mandated fees for administrative costs. And all states except for South Carolina use an electronic income withholding order portal. So those child supports normally take precedence over most of the involuntary deductions or voluntary deductions. Now the maximum amount for child support could be 50 to 65% of the disposable income, depending on how far that employee is in arrears. So that has a higher, you're able to pull more money out for that. Then there's the federal tax levy, which would come after the child support is already paid, and the IRS is going to send a form to the employer to notify them of this levy. Copies are also sent to the employee, so everybody knows that it's coming, and it would take effect 3 days after the receipt. Then pension and retirements are also very common deductions to have out of your paycheck. So most employer based retirement contribution packages do require some employee contributions. Even pension plans will require some employee contribution into it. So a lot of times it's so much comes out of the employee's paycheck and the employer matches that or matches half of that. With the oil and gas company I worked at, they were very generous in their 401k plan. So if I gave 6%, they matched it fully. So they gave 6%, I gave 6%. But then because we had some of our well tenders who did not contribute, they just wouldn't do it. Like, I don't think they saw the big picture to realize that they should. The company was very generous in that they still gave them 3% into their 401k. So even though that employee himself did not give anything, the employer still gave 3%. So again, that was very generous. Not all companies will do that. Let's see. And so if you're a smaller company, so that third bullet point, the employer could set up individual retirement accounts for the employees and then take deductions. When I worked at the plastic injection molder, which was a very small company, we did more of like a profit sharing type of a retirement account. So if the company had a profitable year, the president would say, okay, let's give $50,000 into the retirement plan, and then it went based on your income level. So if you had a higher income, you got a higher cut out of that $50,000, and then that he would contribute into an IRA for the employees. And that too, the employees didn't have to contribute anything. It was just more of like a profit sharing type of a retirement account. So how do companies pay wages? By check or by electronic transfer. I feel like most companies now have gone to the electronic transfer where it's a direct deposit right into your account. And then you will still get like a pay stub emailed to you, or maybe you got to log in to the account and you can pull it down and see what it is. I do know that some factories like Shears here locally uses pay cards, so that it's like a debit or a credit card. So every Friday their checks are just loaded onto that debit or credit card. And that makes it nice for people who don't have checking accounts. Because if you, like, to go back to the oil and gas company, we wanted to make it so that everybody had to do the electronic transfer, direct deposit. But we had some of those well tenders that did not have bank accounts and they didn't want to get them. So we always still had some people that we wrote just manual checks for, but now what you would probably do is that pay card. So then it's still electronic, but then they can use it just like a debit or a credit card. Then you, as a payroll manager, you do have to look at unclaimed wages though. So you'll have to look through your payroll account and see if there's any employees who have not cashed their check. And then if it's been so long of a time, depending on each state, you're going to have to submit it as unclaimed property to the state. And then they'll hold it for so many years and try to contact that employee. And at the plastic injection molder, it was a kind of a tough job if you worked out in the factory. So sometimes we would have those people who came and worked one day and they never came back because it wasn't the greatest job in the world. So we had those unclaimed wages because then we'd have a check for them, but they never wanted to come in and get it, or we didn't have even an address to mail it to because maybe they just started and we didn't have even all the paperwork put together, that type of a scenario. So then those we would have to remit to the state as unclaimed wages. Workers' compensation insurance, again, every state is a little bit different. For the Ohio, we have an Ohio run workers' compensation. So we would, as employers, you pay premiums based on what type of job you're offering, and then it comes along then with a certain percentage. So like at that plastic injection molder was a little bit more of a dangerous job. I mean, people could be injured. They're working these heavy presses. So I think our workers' compensation rate was like between 5 and 7% is what we had to pay. But then if we had office workers, they would be a different category, and those were maybe like 0.3% or a very small percentage because an office worker is not going to have the risk of getting injured as easily as a plant worker. So again, it's a certain percentage based on the class of workers. For Ohio, you pay semi-annually, so twice a year. And and you're looking at your payroll records and figuring out those different categories and multiplying them by the percentages and paying those in. Okay, so that is it for Chapter 6. Please look through the notes because it gives you some examples of kind of the journal entries that are created, because that's really what you want to be able to do.